Good afternoon, everyone. Happy Tuesday. Today is Tuesday, September 8th, 2020. It's the first day of the work week since we had off for Labor Day yesterday. I hope that everyone had an enjoyable, prosperous. I smelt the cookouts yesterday. Hunger was satisfied yesterday. I was riding my bike through the park yesterday afternoon, and the grills were out. No one was worried about COVID. It's just out having a festive good time and getting their eat on. And I hope that all of you guys stayed safe, enjoyed yourselves, and had a very, very festive and enjoyable Labor Day yesterday. So I took the day off yesterday from posting on Facebook for both Wealth Our Way and on my personal page, but I'm right back at it now. And with the success that I had with the series on building wealth from scratch last week, I decided that this week we will also run another series. The series this week is going to be all about life insurance. So for those of you who do not know, of the 22 years that I have spent in the financial services industry, I'm about to sneeze. That is one of the benefits and disadvantages of doing a live. So you can't stop when the sneeze is going to occur. Anyway, when I first got in the financial services industry, as we talked about before, it was as an investment professional. I spent many, many years doing various elements of the financial services industry to now be to the point where, as a financial planner, I'm able to address every area of people's finances because I have experience with some of the top firms in America working in different areas. I had the benefit of working at New York Life Insurance Company for 6 years and learning all things about life insurance from the New York Life way of thinking. I then spent some time at a national insurance brokerage and got an opportunity to see the various ins and outs of insurance outside of New York Life. Learned some very important, I want to call you by your government, but I use your Facebook, so what's up, lady? In any event, I have come to the point now where I have a saying when it comes to finances. There are no such thing as a bad financial product. What there is are bad financial marriages. You can take something as safe and as insured as a CD, which is a certificate of deposit, and if you use it in the wrong scenario for someone, it could be disastrous. So I want to talk about life insurance this week because life insurance tends to get a very bad rap because life insurance is something that people don't understand. More importantly, especially in our community, life insurance is something that's not always valued. I've heard everything from I'm not leaving my kids any money because nobody gave me anything, to I'm not getting any insurance because I don't want my wife to kill me and have some other dude sitting up in here drinking my Budweisers. I've heard all of the reasons not to have life insurance. I got it at my job. It's a ripoff. I even have the benefit of having friends who follow the types of faith where they feel as though insurance is a sin. It's very, very interesting, people's take on life insurance. I want to demystify life insurance this week. One of the reasons that I do these 15 minutes of finance, and one of the reasons that I have the website, wealthourway.com, and one of the reasons I have the company, Wealth Our Way, is to spread financial literacy in our community. I don't sell life insurance anymore. I don't sell stocks and bonds anymore. I don't sell mutual funds anymore. So if you want to call somebody or go somewhere where you can get an unbiased view of why a product is or isn't good for you, this is the place to come because there's no sales pressure here. These things are all free. First of all, 15 minutes of finance is free. Going through our website is free. If you become a Wealth Our Way client, that's not necessarily free, but that actually makes you money. So this is not a cost proposition. This is an education proposition. So let's get into life insurance. Life insurance was originally intended for one purpose and one purpose only, to provide a continuation of income or just a pot of money for the survivors of someone who passed. Thanks, Big Joe. Appreciate you, baby. So the federal government, because life insurance was intended to be for widows and orphans, the federal government made the proceeds of life insurance tax-free. It's not considered income when you get life insurance. Well, that's a blessing. And as we all know, there are some very intelligent people who walk this planet and who live in this country. And when they hear the two magic words, tax free, they've of course been able to morph life insurance into more than what it was originally intended for. And I argue that that's beneficial to all of us. The problem becomes there are certain ways that life insurance is utilized that some of us have no reason even entertaining. There are certain life insurance policies that some of us have no reason looking at. We need to know what our situation is and what policy is best for our situation. So one of the things that I explain to my clients when we're doing financial planning is we have a number that we want to get to in retirement. That's normally what I do. I start with someone wherever they are and I say, we want to accumulate a certain number when you get to retirement that you want to be able to live off of from the time you retire to the time you pass away. In between today and the time we get to that number, you're earning an income. Whether you have a business or whether you're working, you're earning an income. We are taking a part of that income and putting it away so that we can get to that number. So all of that makes sense to everybody. I say, well, there are one of two things that can happen that would make it so that we don't get from where we are today to that number. And that is if you die or if you lose your ability to produce your income some other way. So you can lose your ability to produce your income from a disability, you can get fired, you can die. I can insure two of those things. If you pass away, I can make sure that there's money coming to your people to get to that bucket that we tried to get to. If you lose your job because of a disability, there's an insurance against that as well. The reality is that when you're going from point A to that retirement, there are normally people who are dependent upon your money. So you're putting a little bit away for yourself, but the rest of it you're living off of today and supporting people. So I do a whole graph on a board. And today, actually, you guys get to see me in one of my offices. I'm actually in Long Island today, up here at one of my business partners' offices. So this is where I do all of the sports and entertainment work that I do. So going from today to try to get to your retirement, we've carved out the money that we want to put aside for you. Now I'm going to look and say, your heirs, the people who live with you, if you don't come home tomorrow and your paycheck doesn't come home tomorrow, how do we keep them in the same quality of life that they're used to coming home to? And the answer to that is through life insurance. Or if you get hit by a car and you can't work, how do we keep your paycheck coming? The answer is disability insurance. And I'll deal with disability insurance in another week. Life insurance, however, is to replace your physical earnings power right now. So here's a question I ask people. If you had a machine in your basement and this machine cranked out money every time you touched it, you plug it in, it cranks out money, how much would you be willing to spend to make sure that machine always worked? And nobody hesitates to give me a healthy money answer. However, when I turn the question to how much are you willing to pay for your life insurance, I get that range of answers from, oh, I don't want it, I don't need it, I'm not gonna pay too much for it. Well, you are the machine in your basement. If you think about how much money it is you make every year when you go to work, you're the machine in your basement. How much are you willing to pay to make sure that machine continues to spit out money? So I'm a 50-year-old man. I still have 3 children under the age of 18 that I am fiscally responsible for. I have a 12-year-old son, a 16-year-old daughter, and an 18-year-old daughter. This is not to mention my stepkids, and this is not to mention my adult kids who still rely on me for money. But just my moral obligation to take care of these 3 kids, and I take them through college. So through age 22, 23, I have a fiscal responsibility for a 12-year-old to get through age 22, 23. So for the next 10 to 11 years, I want to guarantee that my income doesn't go away for this kid. Life insurance can do that for me. So we are very familiar with what is called term life insurance. So today, I'm going to talk about the different types of insurance from a very high level standpoint. And then as I did last week, as we go through the workshop, I'm going to take a deeper dive into each category. So today we're going to talk about the difference between term insurance and all the other insurance, which I call permanent insurance. And of course, I like to make it rhyme. So it's either term or perm. So term insurance is straight value of life insurance. I tell people think about term insurance as auto insurance for your life. You have a peril, and the peril is your death. Somebody gets a check. It's that simple. We don't do anything else with term insurance. Somebody dies, check gets written. Somebody dies, check gets written. Now, ironically, I'm gonna be a liar right off the rip. Now we have term insurance policies that do a little bit more than that, and I will get into that another day this week. But I want to deal with the chassis of you pay a premium, you pass away, somebody gets a check. One of the things I had to learn myself, so I was a financial advisor since 1997, had my own life insurance policy that I bought in 2003 that was expiring in 2013. It was a 10-year term insurance policy that I bought from a company. I didn't know that, and I was in the industry, so I know this is why I always tell you guys, when you don't know things, it's okay. I was a financial advisor, but I didn't know a lot about insurance. When I had a 10-year term insurance policy, I thought that for 10 years I had insurance. And come year 11, this thing magically just went away. That's not the case. When you buy a term insurance policy or any insurance policy, so long as you are willing to pay the premium that the company is asking for, they cannot stop giving you the insurance once you have it. So when you hear of a term insurance policy that has a number in front of it, 10-year term, 20-year term, 30-year term, so long as you make a premium payment, they can't cancel your insurance. When you have the year, that means how many years the price you've been quoted is guaranteed to stay the same. So when you have a 10-year term policy and you were told it's $50 a month, they have to honor it at $50 a month for those 10 years. The magical thing is, in year 11, your insurance is still in place if you're willing to pay for it. But the company no longer has to honor $50. What you normally see in an instance that you get to the end of your quoted term, you end up going up significantly. You'll go from $50 a month, for instance, to maybe $430 a month. And who's going to pay that? No one. So you're going to go back to the board of getting underwritten, and underwriting is the process of determining what health level you will be getting insurance issued to you at. So some people, like myself, because of my weight in the past, and you know, Big Tank is down 100 pounds this year, but because of my weight in the past, I had gotten to a point when I was uninsurable. So when that insurance expired in 2013, from then until this year, 7-year period, I didn't have enough insurance because, what did Bruce say? Shut up, dog. So I didn't have enough insurance because I was physically over the weight limits for an insurance carrier to insure me. One of the things that I talk to people about all the time in our community about the importance of getting insurance as soon as you can get it, because we don't know when we're going to be uninsurable. Insurance is a discriminatory product, and not discrimination the way we're used to, discriminatory in two major categories: age and health. The older you are, the more insurance costs. The less healthy you are, the more insurance costs. So it is illegally allowed to discriminate against you for those two reasons. So I'm a huge fan of getting insurance on children so that I know for a fact that I have locked in my child's insurability. We will talk about that later in the week because I'm not a fan of putting term insurance on children. I'm a fan of putting permanent insurance on children. There's a reason for it. I'll talk about it later in the week. Back to term. You buy term insurance to make sure that if you pass away, your income is replaced. So I normally do a very simple human valuation calculation when I'm sitting with my clients. But I tell you, and on my website there is one, there are a bunch of actual real calculators where you can put they'll ask you a bunch of questions and tell you how much life insurance you need. I promise you, unless you're a very nervous person or a math major or you've worked in financial services, everyone who's watching this or who will watch this thinks they need less insurance than they actually do. And when they're told how much insurance they need, they normally think it's because someone's just trying to sell them something. So here I am, the dude that's not trying to sell you anything. I'm going to tell you how much insurance you need. You're a 35-year-old, married with 2 children and a 30-year mortgage. You make $80,000 a year. And I don't know how much your wife makes, but her and your kids are counting on your $80,000 a year. I tell people we can choose one of 3 ways of looking at what insurance we need. I can take you to your retirement age, so 35, and you want to retire at 67 or 65 or 60, I can take you there. Or I can take you to the youngest kid is 23, or I can take you until that mortgage is over. We can make all those decisions. So let's say the guy says, take me till my mortgage is over, take me out 30 years. So I'm going to price his life for 30 years. 30 times 80,000 is $2.4 million. Just crude math, I'm very confident of that. 10 times 80 is 800, and 3 times 800 is 2.4 million. $2.4 million of term insurance that this person needs. Once again, you tell somebody, I've done it. You tell somebody they need $2.4 million of insurance, they throw you out their house. If you're not, very much communicative as to why it's the case. They think you're trying to sell them something. And then the first thing that jumps into their head is, I can't afford that. Without having any idea how much it costs. It just sounds like it's very expensive. Well, term insurance is not very expensive. And I'm here to tell you, you can't afford to not have it. I get sick to my stomach when I see GoFundMe pages for trying to bury somebody. It's embarrassing and it's disrespectful. I had a very good friend of mine pass away, I want to say it was 2 or 3 years ago. And this person, I didn't know I thought he was rolling in money. Everything about his life appeared to say to me, he had everything financially taken care of. I oftentimes don't bother my friends with talking about their finances because I think my friends know what I do, and if they wanted something, they'd hit me up. So I didn't, I don't harass anybody. All you cats who are watching this know me for years. I've never called you and said, hey, let me talk to you about your money. So that's why I'm doing this now. So in any event, my man passed away. I saw his daughter put on Facebook a GoFundMe account because there was not enough money to bury him. And I thought he had tens and hundreds of thousands of dollars. He had a big house, he had motorcycles, he had all types of things. And I was shamed as a financial professional that I didn't help my friend. So what I did that month was I called everybody who was in my phone just off the rip. Hey, you're buying a term insurance policy. You got a kid, you're buying term insurance. You buy a kid, you're buying term insurance. So I think I sold 35 life insurance policies in 10 days. Term insurance not only is not expensive for you, it doesn't pay a lot to the person who sells it. So I would call people and tell them, look, I'm not calling you to make some bread. I get paid half of what you're going to pay in premium. So the average policy I was selling was $30 or $40 a month. So let's call it 35 to cut the difference. The annual premium on a $35 term policy is $420. I got paid half, $210. I am not bragging, but any of you who know me know I'll spend $210 on dinner. So it wasn't like I was trying to get rich off the people I was calling. What I wanted to do was make a difference and solve issues in my community because I was embarrassed that I let a friend pass underinsured. I never sold that many insurance policies again. I got off my high horse and went back to trying to make big money, which is what I normally do in finances. But the lesson was never lost on me that I sold 30-some policies because I was passionate about helping people. And that is what has moved me to this point in my career now, why I do this. Not for money, but to help people with information. When you value your life with the term insurance, we go back to the $2.4 million example. Most people, if you're thinking, think about it this way. I told you I'm valuing your life from now for 30 years. So I'm not factoring in raises. I'm not factoring in the cost of living. You actually probably need more than 2.4 million. But I'll let you argue that you don't because the insurance proceeds is tax-free. Your 80,000 is taxable. Let's say we wash it all out. Let's say we don't want to get too technical. The other thing that people realize if they're thinking is every year that passes is a year that you successfully lived. So technically, you don't need the 80,000 of insurance for that year moving forward. So, and you're right. If we're purely trying to replace your income and you've earned that income successfully, you need 80,000 less insurance. They do have products out in the market called decreasing term that go down a little bit every year until it goes to zero. I'm not a huge fan of decreasing term insurance. What I choose to do for people is what's called layering term insurance. So for the person that needs 2.4 million over the next 30 years, I may do a $1 million 30-year policy, a $1 million 20-year policy, and a $500,000 10-year policy. He'll get 3 separate term insurances. And from the very beginning, he'll have 2.5 million of coverage. He'll pay for all 3 premiums for 10 years. And after 10 years, he'll stop paying for the $500,000. Now he has 2 million of coverage. He'll pay for the next 10 years, then he'll stop paying for the second one, and for the last bit of time, he'll have 1 million of coverage. That keeps it in line with his income. That's term insurance. Permanent insurance is a much more complicated beast. First of all, it's way more expensive than term insurance because you're not just getting the pure coverage if you die, you're also getting some form of a cash value portion of your policy. You're getting what most people consider to be a savings component. So what I'm going to do tomorrow is go into whole life insurance. And then I think I'll have enough time tomorrow to go from whole life to what is called limited pay whole life. I'll talk about the two of them tomorrow. On Thursday, I'm going to talk about universal life. And then on Friday, I'm going to answer questions that came up this week. I'm going to tie everything in with beneficiaries, with trusts, with everything that goes down to insurance. Because I'll be one day short this week because we didn't have Monday, maybe this conversation carries into next week. But we are going to get through this answering and addressing all things insurance, so you never have to be intimidated by an insurance salesman again. You never have to worry about whether you're underinsured. You never have to say, well, I have job insurance, so that's enough, because you don't. Your job insurance is for you when you're at the job, you leave. The insurance may or may not come with you. It's never a good idea to base your insurance on what you get at your job. So I went way over 15 minutes. It's 12:50 now. This thing just goes so fast for me. I apologize. But I appreciate you guys tuning in. Inbox me any questions you may have here on the Wealth Our Way page or to the www.wealthourway.com. And I'll see you guys tomorrow at 12:30 where we talk about whole life insurance. Peace.